Hey guys, this is Mrs. Scherenberg. This is the Appendix D lecture over investments. The notes look like this. I'm not sure why. Just scroll down and we will get started here. I want to point out right off the bat that on these particular notes, um, I am really just jumping right in and addressing the homework problems. Again, the numbers have been changed, but this will help you get through homework for Appendix D. There's also no intro activity for Appendix D if you were looking for that. All right, so here's what Appendix D is about. It's all about a corporation investments. And real generalized speaking, basically, sometimes a company is going to find that it has excess cash. They don't need it for current operations. So instead of letting that cash just sit idle, companies invest their cash. Okay, so companies are going to try to make an investment and make some money. So this is when a company actually buys stock in another company. This is not them selling stock and raising cash. This is a company trying to make use of their idle cash and they're purchasing stock in other companies. So here we go. On September 12th, 4,000 shares of Aspen Company were acquired at $50 per share, and they paid a $400 brokerage commission. On October 15th, a 60% share dividend was received. And then on November 10th, 3,000 shares of the stock were sold at 40, and they had a brokerage commission. So when we do these computations, we're going to round to 2 decimal places. And when required, we're going to round to the nearest dollar. Journalize the entries to record the original purchase, the dividend, and the sale. Whew. Okay, well, let's do this first. Let's take that 4,000 times the $50, and that becomes 20,000. And then don't forget, they also had to pay $400 for their brokerage. So we get this $20,400 price. Okay, so September 12th. September 12th. Investments. This is the debit. What are they getting for their cash? They're getting investments, comma, Aspen Company stock. Okay, so if I take 4,000 times 50, let's do that real quick. Okay, that should have been a 200,000. Bear with me here. So the investments, Aspen Company stock, that number is 200,400. Okay, and then what did they do? They had to pay cash to get that. Okay, now I'm going to do a little calculation over here. Even though they paid $50 per share, if you take the 200,400 and you divide it by the 4,000 shares, you're going to get that they actually paid $50.10 a share. And that's going to be important in a minute. That 10 cents extra represents that you had to calculate in that brokerage commission. So they really didn't pay $50 a share. They paid $50.10 a share. But anyways, that's September 12th. Okay, then on October 15th, if you recall, a 60-cent dividend was declared. So they got some nice cash. This is why they're investing. They got 60 cents times their 4,000 shares that they purchased. So they got 2,400. And we're going to credit that to dividend revenue. Dividend revenue, 2,400. Then on November 10th, they sold some shares. And they sold them for 3,000. This is going to be a 3-liner. Okay, so let's do cash. The amount they got was 119,800. How do we calculate that? We took the 3,000 times the $40 per share, and then you have to subtract the 200 brokerage commissions. So they ended up with a net cash of 119,800. The next 2 entries are tricky. Skip a line and credit investments Aspen This amount is $150,300. This is where we took the $50.10 times the 3,000 shares that they sold. The difference between these two numbers, it's going to have to be a debit. Let me just change my pen color here so we can see it. $30,500. And the account that goes with that is loss on sale of investment. Loss on sale of investment. Okay. All right. Homework problem D3. Bond investment transactions. So a company goes out and buys, pays some cash, and in return they get this Iceland Incorporated 5% bond, and it has accrued interest of $1,400. Here's how to, this is just a strange little problem. Here's how to do this one. So they did get, this is the debit, they got investments hyphen Iceland Incorporated bonds, and those were valued at $140,000. We are also going to debit interest receivable of $1,400, and they paid cash for all that. So adding those two things together, it's $141,400. Then they received their first semi-annual payment. So remember how bonds work. We're going to take $140,000. It was a 5% bond, and you can either take it times a half or divide by 2 because there's 2 payments a year, which this tabulates out to $3,500. So they received this cash payment of $3,500, and they're going to credit out. This is kind of tricky. They're going to credit out that interest receivable that was owed to them, and the rest is going to go into interest revenue. All right. Then they sold 90,000 of the bonds at 102 and accrued interest. All right. Well, let's take 90,000 times 102%, if you will, and you should get. Let's tack on that $900 as well. Once you do that calculation, you're going to end up with this number, $92,700. Okay, so the cash they received is $92,700. They're going to credit interest revenue for that 900 portion. They're going to credit, skip a line, we'll do a gain here. Okay, and then the last line is investments, Iceland bonds. Okay, so the bonds that they sold were only 90,000. So once you take all these numbers into account, what was the gain? So 900 was the interest revenue, 90,000. So you have this 92.7. The gain happens to be 1,800, and the account is gain on sale of investment. Okay. Homework D6. On January 2nd, Maltese Company acquired 40% of the outstanding stock of Kane Company, and they paid $600,000 to get that. They earned $160,000. Excuse me. Kane, the company they purchased stock in, earned an income of $160,000 and paid dividends of $40,000. Okay, so now we have to figure out what's going on with Maltese Company, not Kane. Journalize the entries for Maltese Company for the purchase of the stock, the share of the income, and the dividends received. So here we go. January 2nd. Remember, Maltese went out and they made this investment. They had to pay some money for it, but we're going to call it investment in Kane Company. And it says that they paid $600,000 for that. And they paid cash. Now, remember this 600,000, it represents 40% ownership, if you will. 40% of the entire stock. So it kind of represents 40% ownership. So then the whole year goes by and it's December 31st, and Kane Company comes out and says, hey, we had earned income of 160,000. Well, this is what Maltese has to do. The journal entry looks like this. Investment in Kane Company, and I'm going to put up a number here and tell you how I got it. And then the credit goes to this account, income of Kane Company. Again, this is still on Maltese, but they own 40%. So here's how I got 64,000. I took the 160,000 income times 40%. Okay, that's how you get the 64,000. Then finally, December 31st, they paid dividends of 40,000. Well, they're not going to get the 40,000, right? They're only going to get 40% of that. So Maltese is going to receive a $16,000 dividend. And so Maltese got cash of 16,000, and they're going to credit investment in Kane Company for 16,000. Okay, so follow along that pattern when you do your homework. If you want to read up more, I know I'm sort of skimming this. Please, 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 by all means, read the chapter. Homework D9, fair value journal entries, trading investments. Okay. We have the end of this page and one more page to go. The investments of Cadillac include a single investment, 18,500 shares of Chiefs common stock purchased for $42 per share, including the brokerage. These shares were classified as trading securities, and as of the balance sheet date, the share price had increased to 50. So we got to journalize the entries. Not only when they got the investment on February 24th, but now we have to just record this adjustment to the value because the stock has gone up. So what does this look like? Well, here's the journal entry. February 24th. Investments, and what was that investment in hyphen? It was in Chiefs stock. And they paid $777,000. How did I get that? 18,500 shares, and they paid the $42. And how did they acquire that? They used their cash, $777,000. Okay, now they have the stock. Time goes by. It's all the way to the end of the year. It's December 31st. You have to do this for trading securities. You have to evaluate at the end of the year, even though you're not cashing it in, like what's the value of it? Here's a new account. The debit goes to valuation allowance for trading securities. And I'm going to give you this number, 148,000. I'll tell you how we got it in a minute. The credit goes to unrealized gain. It's unrealized because they didn't actually cash it in. Unrealized gain of trading securities, 148,000. You probably know how we calculated this, but remember the price had increased to 50. They bought it at 42. So if you think about it, it went up by $8. So I'm taking the 18,500 shares that they own times 8 to get to the 148,000. So that's how to do that one. Homework D14, fair value journal entries available for sale investments. Okay, this time Ravens, they bought $300,000 worth of Raiders bonds. These bonds were classified as available for sale. And so now we have to do this balance sheet fair value thing. And this time the value of the bonds declined. Okay, so the kind of the last one was sort of like a gain, and this one is going to be more like a loss. Okay, so January 1st, let's see what it looks like when they acquired the stock. It's investment, and then you do a hyphen and you say what the investment was. Raiders Inc. stock. Raiders Inc. stock. They paid $300,000. And of course, they paid with their cash. Now let's do the fair market. It's the end of December 31st, 20Y7. And the debit is going to be to unrealized loss. Remember, losses are debits, gains or credits. Unrealized loss, and I think it's specifically on, I don't know for sure on this, double check me. It's either on trading securities or this one on available for sale. I'm not quite sure the label on this one. The amount is $15,200, and we'll look at that number in a minute. The credit goes to, it's still this valuation allowance account for trading securities, I believe is what it is. 15,200. How did they get that? If you take a look at this number minus this number, you'll get that 15,200. So subtract that, and you'll get the 15. So that's how you do that one. All right, last page here. We have two more homework. This is D10 and D12. Chargers Bank Corp purchased a portfolio of trading securities. So they have a whole portfolio. The cost and fair value of this portfolio on December 31st was as follows. So this is at the end of the year. If you look overall, it's down by $2,200. Okay. So journalize the entry to record the adjustment for the trading security portfolio to fair value on December 31st. This one's goes kind of quick. December 31st, it went down, and you can do the portfolio as a whole. Unrealized loss, trading investments, debit 2,200. And once again, we're going to credit that valuation allowance account for 2,200. So if you have the portfolio, you can look at it. This is the total cost they purchased everything for. By the end of the year, it's down. And you just subtract and use that 2,200 number. Okay, finally, we are going to do the balance sheet. What does the balance sheet look like for trading investments? Chapter 12, at the very end, we kind of looked at what does a balance sheet look like for stockholders' equity. Now we're going to look at what does the balance sheet look like for trading investments. So remember, these are companies spending their money and getting these assets, if you will. They're getting these little trading investments. Okay. And so here we have Aristotle Company, and they purchased Squawking and Freud. They bought some shares, and here's the cost. So now let's assume it's December 31st, and Squawking had a market value of $480 a share. Excuse me, let's make that 48. Now it's a boo-boo. It's supposed to be 48, not 480. And Freud had a market value of $22 per share. So let's do this little valuation over here. Valuation. First, Squawking. 48, not the 480, times 800 shares owned, right? And that amount is 38,400. And then Freud, at the end of the year, it was 22, and they owned 1,700 shares of that. So this thing is worth 37,400. When you add these two together, it's 75,800. Okay. And if you look at that 75,000, and remember, it cost them 73,000. Okay. So if you take 75,800 minus 73,000, we're going to get this number, 2,800. Okay. So did it go up? Did it go down? And here's what the balance sheet looks like. Okay, this is an asset, current asset. They got trading investments at cost, 73,000. That's how much they paid for it. The valuation allowance. This is where you put, hey, up 2,800. Trading investment at fair value becomes this number, 75,800. And that is how you do that problem. That is the end of the Appendix D lecture.